full disclosure, I'm short the equity markets right now from today. I sold into this rally. I'm short gold into this rally, and I'm obviously still short crude oil, right? I'm still looking at longer term for that 40 to 60% haircut in the markets. I do think that we're going to go into a bear market. I do think that we are going significantly lower. We saw these same warning signs during the internet bubble, which collapsed in 2001. We saw the same during the housing bubble, which collapsed in 2008. And we're seeing the same kind of warning signs.
It's Wednesday, April 8th. The S&P 500 is up 2.5%. The Nasdaq's up 3%. Gold spiking 2%. It just looks like a risk-on day today. Todd Bubba Horwitz is back with us to break down what's going on. He's a founder of BubbaTrading.com. Welcome back, Bubba. Good to see you, as always.
Dave, it's always a pleasure. I'm looking forward to it.
It looks like Iran and the U.S. have reached a ceasefire agreement for now. There's complications, of course, as Israel continues to strike Hezbollah. And it looks like Iran perhaps is back to closing the Strait of Hormuz, except for a limited number of vessels. But anyway, there was a ceasefire agreement made last night at 8 p.m. Eastern Time, past Trump's deadline of reopening the Strait of Hormuz. And now markets are taking the bid. Markets are interpreting last night's events and today as good progress. Now, you were on the show a few weeks ago, 3 weeks to be exact. You called oil the biggest short opportunity of a lifetime, I believe. I'm paraphrasing slightly, but I think those were your words. Oil is currently trading at WTI is at, let me just pull this up, 189. So in a sense, you were spot on. And oil just, oil reacts to the war. So tell us about oil right now at 89, but more broadly speaking, and reflection, oil being a reflection of the current conflict. Do you think oil is accurately reflecting risk on right now?
Well, I think oil is reflecting what we would expect to reflect. It was very overpriced, and there was a tremendous amount of fear premium built in. And in commodities, especially crude oil, if you look out into the future, you can get prices going out as far as December. Okay. December crude is trading under $70 a barrel right now. So that is what they call the backwardation, and you look to the forward curve and you can see that the premium that's in it right now is all fear premium. And now that there's some sort of resolution, that fear premium came flying out of the market. So now we're back to trading the overall economy, and the overall economy is not very good. So oil prices should drop, and I would not be surprised to see them, depending on what goes on here with this fear and what happens with the Iran deal. But all things being equal, I would think oil will be back in the 60s before the third quarter.
Okay, so we're not even at your desired territory because it dropped 18% overnight. When something drops 18% overnight, Bubba, do you buy the dip?
Sometimes. I mean, I did buy a little bit when oil was down over $20. I covered a little of my shorts and resold them again. But again, I think there's a lot more room on the downside. I am not afraid of what's going to happen in Iran. And I do believe that the over and under of this deal holding up is probably 3 days before somebody reneges on the deal. So we could see some of that fear premium come back in. But I think people realize that the valuations were crazy. Again, you look out into the future, and that tells you where oil should be priced. And it is just it's still overpriced here. Now, as a new seller, I wouldn't jump in and sell oil here. But certainly I would trade it from here and look to be either a buyer or a seller from this point.
Even if oil does pull back to the 60s, Bubba, do you think the inflation damage has already been done? In other words, the Fed's going to be stuck all year?
I think that is correct. I think the markets are, first of all, the inflation data is not all that correct anyways. We're in massive inflation and we're losing jobs. So you're really putting yourself in a position to go into stagflation, which is obviously a much bigger problem when you think about it. I mean, the last time we were in stagflation was in 1979 with Jimmy Carter. The problem is you're losing too many jobs, okay? And we've had an oversupply of oil in this country. And again, let's go be clear. Only 2% of the world's oil travels through the Straits of Hormuz anyways. So at the end of the day, this fear premium, we're going to get back to real action and real supply demand. And the demand for oil is not really there.
What else is overbought right now?
Well, I think a lot of the tech stocks are still overbought. I still think NVIDIA is probably overvalued from a standpoint. I mean, I think the markets are in trouble. In general, I think this rally today would be classified as a rip your face off rally. They caught everybody short, assuming the deal might fail. And you got this big explosion of about 3%. Now, the markets are a little bit lower than they were or that they got to last night. but I think they're going to head back down again. I think we're going to take out the recent lows and continue to go lower. I'm still looking at longer term for that 40 to 60% haircut in the markets. It's not coming tomorrow. It's not coming soon. But I do think that we're going to go into a bear market. I do think that we are going significantly lower. Again, the lack of jobs, the number of defaults on cars, the number of defaults on mortgages, the people that can't pay their rent. I mean, those are not good situations. And when you're in a K-shaped economy, only the upper end of the K thrives. The rest of the people struggle, and it's not getting any better. And you can see just where I live in Las Vegas, tourism is down 10%.
We're going to come back to the economy, but this is the forecast from UBS. They cut their year-end S&P 500 target from 7,700 points to 7,500 points. Still bullish. We're still at 6,700 points. So slightly less bullish, but still bullish. Where do you stand on this?
I think they're out of their mind. But of course, they're normally going to call for higher prices. The natural growth of markets, if you go back in history, is 8.5% year over year.
Yeah.
So I can't fault their call, but of course, they're calling it for the retail customer. From a trader standpoint and from observing the markets for 47 years, this market's setting up for a big sell-off. You have too many warning signs, even going back into private equity and private credit. You can't get redemptions from BlackRock. I would make the case that the banks are over leveraged once again, and yet Michelle Bowman wants to let them get even further over leverage. These are all problems, and then take on the massive debt that we continue to take on, and that's not a good mix. So the warning signs are very clear. We saw these same warning signs during the internet bubble, which collapsed in 2001. We saw the same during the housing bubble, which collapsed in 2008. And we're seeing the same kind of warning signs. Does it mean that it's tomorrow that we're going down? No, it means that there's too many signs out there that indicate that there's troubles in this market. Now, again, I'm a believer in the market long term, and I'm not liquidating any of my own personal long positions. I'm hedged against them, which I'm always hedged. But as an investor, if you have the capital, you should hold, because again, we can go up higher before we sell. But at the end of the day, I expect a very big haircut to this market. I think the economy is weak. I think inflation is not done rising. I think there's too many issues, and then bring in the debt and the other issues that go along with it. And that brings us to a market that's probably going a lot lower.
These are some longer term problems that you talked about, these structural problems in our economy. But Bubba, how are you positioned in the short to medium term? You said the Iran war. You're not worried about Iran. If the Iran war finds a resolution, don't you expect markets to tick up much higher? And,
no, I think the rally's over. I don't think they're going much higher than where they are right now. Okay, I'm right now. Full disclosure, I'm short the equity markets right now from today. I sold into this rally. I'm short gold into this rally. And I love gold, but for the short term, I think gold's going to come down a little further. And I'm obviously still short crude oil. I don't see this as a meaningful rally. I don't think this is, again, the fundamentals of the market have not changed. The problems that exist, the overbought conditions have not changed. If we look at the CAPE index, which was over 40 a couple of weeks ago, the average, that's the Case-Shiller PE index, the median or the mean of that is 16. It's well over, but it's telling you the markets are well valued and very much overvalued. So again, I don't look for anything here. I look for the markets to sell off. I think that there's going to be better buying opportunities if you're looking to buy. I wouldn't sell out, because I could be wrong on the timing of this. I'm not going to try to time the market, but I don't think the economic problems have been solved. I think the economy is weak. I think we're in a partial recession and probably going into a deeper recession. So I think there's a lot of room to the downside and very little room to the upside right now.
It's not looking great for Trump's popularity. In fact, his ratings have plummeted since the beginning of the Iran war. And so let's suppose we have a Democrat win for the midterm elections. How will that change fiscal policy and ultimately markets?
I don't know that it'll do anything. I mean, if you have a total change, it'll just be a standstill. But again, the issue, we always want to relate the economy and the markets to who's in office and not look back on how long it took to develop the problem that you're in. I don't think it'll have much effect whatsoever. I mean, you might get an immediate sell-off or an immediate bounce, but at the end of the day, I think the markets are going to come back to trading. And if they tested the 200-day moving average once, if they go and break that, then that will be the confirmation that the funds will be selling and the firms will be selling, because that's their big benchmark, is the 200-day moving average. at the end of the day, I think markets will do what markets do. There are little blips and turns, based on the Iran war, for example, based on the election that's coming up. But overall, the economic warning signs, again, we go back to the defaulting on loans, from cars to houses. We go back to mortgage companies trying to make deals, not the companies, but the home builders giving mortgages at half of what they should be. So that's telling you that they're worried. So the concerns are out there. The concerns are real, and you can choose to ignore them or you can choose to act on them, but they're real. And when these things show up, typically the markets take a haircut, and that's what I would expect.
Nobody talks about the cost of being right too late, not the cost of being wrong, the cost of being right. Seeing something coming, understanding exactly why it was going to happen, and then watching it happen without you. Well, gold has gone from $3,000, then to $4,000, then to $5,000 in a very short amount of time. And a lot of people watching this right now knew that this was coming. They felt it in their gut. They understood the deficit spending, the central bank buying, the writing on the wall, but their retirement account never reflected any of it. That is the gap we need to close today. JP Morgan is projecting $6,300 gold price this year. Central banks are not pausing their gold buying, and the people who look back without regret will not be the ones who were the most informed. They will be the ones who actually did something about it. My friends and sponsors at Priority Gold created a free precious metals playbook that shows you exactly how to add physical gold or silver to your IRA or 401k tax and penalty free. They handle everything. You just have to take the first step. So call 866-407-6456. That's 866-407-6456, or take out your phone and text David, D-A-V-I-D, to 24999. You can also scan the QR code here on your screen or click the link in the description down below. Again, 866-407-6456, or text DAVID to 24999. This is from Delta, the airline. Expect June quarter pre-tax profit of around $1 billion on a more than $2 billion increase in fuel expense at the forward curve. Okay, if this is $2 billion of increase in fuel expense at a Q1 revenue of only $14.2 billion. I'm not saying only, I'm just saying compared to the fuel expense. And then they're saying that they're going to meaningfully cut capacity growth. And you were just talking about Vegas and tourism. Now, one of the strongest airlines in the industry is doing this and experiencing fuel cost increases and cutting capacity growth. What does that mean for the entire airline industry and ultimately discretionary spending in the economy?
Well, I think that the airlines, they actually learned after years and years and years of failure that they should hedge the price of their oil. So I'm going to say that that's more of a headline and more of an excuse so they can raise prices because they already know what per seat cost is. Okay. Again, this was Herb Keller from Southwest Airlines was the first to learn that if you hedge the price of oil and know what your per seat is. So they're making a statement. They're giving you an excuse. So if they beat, their stock will perform better. But as far as people being afford to travel, that's becoming different. And we've seen it with the cutting down of number of flights that leave now. And it'll probably get less because, of course, it doesn't do an airline any good to send out an empty plane or a plane that is lacking, is not at capacity.
Let's talk more about this private credit meltdown that you were mentioning earlier. So how would you compare this versus 2008?
I think it's very similar. It's another warning sign that is showing you that you can't get your redemptions from BlackRock. I think that also will tell you that the banks are probably in a little bit of trouble as well. Again, we don't get that information until it's too late. And I would assume before they'll admit to the potential trouble that the banks are in, they'll come out and say to you, we're safe and sound. Very much like what Paulson did in 2008 in September on Face the Nation when he said the banks were safe and sound. And of course, in October, they were no longer safe and sound. I think a lot of the problems get hidden from us and we forgive a lot of things because they have this stupid mantra of too big to fail. Whereas in a free market, nobody's too big to fail. And if you can't make it, then you should be failed. And if you wanted to bail out people, you should bail out the depositors of that bank, not the bank itself.
But are you trading on that development?
I mean,
how would you
short the market? I mean, that's the development I'm trading. I mean, that's just another warning sign for me that says that there's a lot bigger problems than we're willing to admit to in this economy. And that's part of it. I mean, it's not one specific thing that I'm looking at that says, well, this is the problem. To me, the private equity, the lack of redemptions, the banks over leverage, the losing of jobs, the layoffs, and more layoffs to come. To me, that's the bigger problem. And that's what's going to create the eventual meltdown, not to mention that I think some of these pension funds are going to be in trouble as well.
Let's talk about gold. You mentioned you like gold. What about at current prices? Do you still like gold at $4,700?
At this particular moment, I'm sure, but I could be long in an hour from now. But I think it put a great bottom in at 4,100 a couple of weeks ago on that overnight spike. I think gold is going much higher again now. I think we'll see it start, it was consolidating. I think its next bigger move will be higher, I think. I think there's an outstanding chance we could see 6,000 before year's out, if not more. I think silver is going to start to move up again as well. I think we're going to start to see, especially as inflation and other things rise, I think you're going to start to see the metal start to go higher again once again as well.
All right, here's a chart of gold. Let me pull this up and I'll show my screen. Gold's been trading alongside stocks ever since the beginning of the year, and it's been moving pretty much in lockstep. At what point do you think this relationship is going to break? Because this isn't really normal.
I think it's going to break as the equities start to break here. I think it started to break a little bit recently, and I think that once equities start to sell off, which I believe they will, gold will continue to rise, and that will be the gold is the inflation hedge. It is to some people the hedge against their portfolio. But it's really the inflation hedge, and it's the hedge against dollars, which, of course, we know the fiat currency system is one of the worst systems ever because there's nothing backing it. And, of course, the debt that has continued to be created, 43 trillion and counting, that will also bring to the rise of the price of gold because that's the only way they can finance the debt.
What's the driver for gold going forward if you think it's going to go higher?
Inflation, government debt, fear. Those are the three.
People say that gold rose before the Iran war happened in anticipation of an actual strike. And can you just comment on that? I don't know to what extent the gold market sniffs out geopolitical risks before they happen.
I think all markets are on either buy or sell the rumor and then buy or sell the news as it comes out. The flow of information in today's world is so quick that a lot of people had an idea that might be happening, and you did see this sudden rise, but then, of course, you saw the sudden pullback. But remember, we're still 15% from our highs, okay? So it's not like we were charging. I think gold did what it should have done. I think it consolidated nicely. I think it had a blow off to the downside. I think now it's back working nicely in a good solid pattern that should lead to a higher pricing. But markets will anticipate forward news, especially if they have an idea. You will always see things like that happen. But I think the bigger reason for the gold sell-off recently, initially, when equities sell off, normally that brings in margin calls and leverage. So what do people do? They go sell their good assets like gold to cover their margin calls and their leverage on equities, which is totally backwards thinking. You don't sell the winners, but that's what happens. And I think that's when you saw the print in gold down to 4,100. And now you've seen gold come back up to 4,800.
Do you think the dollar is going to continue its strength throughout the remainder of the year?
I think the dollar is going to be stuck between 96 cents and $1.02. Right now, trading at 98 cents. I think it's going to, that pattern you're looking at right there for the last few weeks, I think that's where it's going to stay.
Every single
$1.02. Remember, it's still the reserve currency. And the only thing that will drive the dollar much higher from here is fear, because world countries put money in the US dollar when they're afraid. Okay. And that's what I could see happening.
I wonder if the Fed is going to cause a weaker dollar if they do start cutting rates later in the year.
I don't think first of all, I don't think they can cut rates. I think they've worn themselves out. Because here's the thing: when you look at the rates, they've cut rates 200 basis points. The 10-year notes are up 400 basis points. So the pass on to the consumer has not worked. They're basically paying the banks to sit still. I think the Fed is kind of out of bullets unless there's a real emergency, but I don't see it. And I think that's where President Trump is wrong as well with wanting rate cuts. I don't think rate cuts are the answer. I think that you let the free market trade, and that gives you the true answer of what asset classes and prices are worth.
The fact that the dollar has moved up on conflict, on the outbreak of war, what does that tell you about the strength of the American economy relative to the world?
I think the world economy is weak, and including the United States. I think we're very weak right now. I think the economy is in very, very bad shape. And I think the world economy is in pretty bad shape as well. But again, you go back to the reserve currency, and that is where countries go to put their money, is into the US dollar, because it is still recognized as the world reserve. I mean, they put BRICS down, but the BRICS nations tried to take over and create their own, and it didn't work out so well. China continues to try to become the reserve currency, and they haven't been able to do so. Now, someday maybe it will happen, but until that happens, money will flow to the dollar when there's fear. That is what has always been part of the dollar, and it's going to continue. I think that the Fed can devalue, but still the price, again, all they're really doing is devaluing through inflation. We have good inflation and bad inflation. Good inflation is when there's an overwhelming demand and the economy is thriving and people are out buying things. Bad inflation is when it's created by the Federal Reserve because they're reducing the value of your actual dollar. Okay. And, you're making less. I mean, you go back to the equation in 1985, the average income was 25,000. The average house was 75,000. Today, the average income is 70,000. The average house is over 500,000. So you have a dramatic devaluation of that currency, which is part of the manipulated, fraudulent fiat currency system.
Okay. Now, Todd, anything you really do like right now?
Not really. I like being short right now, to be quite frank. I don't really think there's, let me take that back. I do like the grain markets quite a bit. Long grains, I think the grains are very strong. I have a chance for a big move here. There is a WASDE report tomorrow, so I'd be careful. But I think grains look good. Of course, I always love gold. I always love silver and platinum. So those are things that I do like and I own. But other than that, there's not a lot of excitement for me. Now, again, it doesn't mean that something won't drop to a price that all of a sudden I'll say it's value. I mean, I go back to 2008. Amazon was $30 in November of 2008. Okay. By the time the market actually bottomed in 2009, Amazon was already 60. So I think when you're looking for value and stocks that might have been overbeaten down in the most recent movement. Now, I don't think we've seen anything that's been overly beaten down recently, but I will be looking for those. But here, there's nothing here that I'd be jumping off my chair to go run and buy right now.
Well, this is from, I'm seeing similar articles every day, but this is from PBS. Farmers are warning of a food price spike as war drives up fertilizer costs. About a third of the world's fertilizer supply passes through the Strait of Hormuz. First of all, the Strait of Hormuz isn't exactly closed. It's a selective group of vessels that are allowed to pass. So we don't know to what extent fertilizer will actually be squeezed. But let's just take the farmers' warning at face value. Are you long certain commodities, agricultural products in the futures markets?
Yeah, corn, wheat, and soybeans. Okay.
And you're expecting prices to go to what kind of level here?
I'm expecting a 25 to 30% rally across the board. I think that the inflation trade will kick in. There are problems because, again, the high cost of fuel is hurting the farmers. The high cost of hydrous ammonia, which is the fertilizer and fuel, the farmers are hurting. They're actually farmers that are planting at today's prices are actually planting at a loss right now. Okay. They're very close to break even, if not losing money, if these prices don't rise. So again, we get back to, are we going to plant? Are we going to have a shortage? And obviously one of the problems is you go back to the supply demand. There's still an oversupply because there has not been any weather issues throughout the globe over the years. So over the last few years. So if we see anything, that will drive prices higher. Inflation will drive prices higher. And equities, if they go down, which I expect them to do, that money will be looking for a home. And typically a big secondary investment place for fund money is the grain markets. So if you tie that together, you have a very little risk by buying grains here, but you have a tremendous upside potential.
People are not going to be able to afford a lot of things once food prices go up, fuel prices stay high, and the economy weakens, the labor market weakens. And we talked about how the Fed is stuck, but really, they really should be lowering rates when you think about it. Do you agree?
No, I don't think they should lower rates. That's my point. Okay. I think that the Fed is ridiculous, and they should have never cut rates in the first place. Again, look at the 10-year notes. When the Fed first started cutting, the 10-year notes were 3.9. Today, they're 4.3. Okay, they may be a little lower because the futures are up right now, but let's say we're 4.5 last week. The interest rate to the retail borrower has not come down. It only has allowed the banks to make more money. The rate cuts do not transfer to the consumer. The rate cuts are strictly for the bank. The banks are using the Fed funds rate to borrow. Whether they want to pass that savings on to the consumer or not, that's up to them. They don't have to do so. And they have not done so. That's why mortgage rates are still north of 6%, okay, if not higher in a lot of places. So no, the Fed should not cut rates. The Fed should be totally ended because they're a cartel of a group that is run by the banks for the banks. Okay, they don't do anything that benefits. I mean, what business can you go into where you blend out, you make billions of dollars, and when you go bust, the Federal Reserve bails you out? Now, what kind of business is that?
Yeah. All right. Well, do you think that consumers can get by this year the same way they did last year? In other words, no. How will our living standards change this year?
I think there's going to be a lot of trouble. I think there's a lot more homeless people. There's a lot more people that are having to size down. There's a lot more people that are building dramatic, massive credit card debt. And of course, the credit card companies did them no favors because they allowed them to extend payment out into 2027 with no penalty now. But all they're really allowing them to do is build up more debt. So when it comes due, they're going to have to pay a lot more. And of course, you never get out of that debt, that credit card debt at usury rates that they charge. And of course, many are not aware, but you cannot go bankrupt on your credit card. Okay, the lobbyists have beaten that, so there is no bankruptcy relief from credit card debt.
Great. The final question I have for you, Bubba. At what point do you see the S&P 500 recovering? In other words, what would make you bullish on the stock market? What would need to change in the economy? What would need to change with monetary or fiscal policies?
Well, I think the first thing that would make me more bullish is if we finally had a sell-off and we saw some of these overvalued stocks sell off. That would be number one. I think that we need to go into a bear market before I would get bullish. And again, I got to give you full disclosure. I'm still long the market. I'm hedged, but I'm always in. Okay, I'm always 100% invested in hedge. But for me to get overly bullish, I would need a pretty substantial sell-off. We would have to test last April's lows, which is like 5,200 in the S&P. Then I would start thinking about it. I still believe there is a 40 to 60% haircut coming to this market. Okay. And I'm not saying it's tomorrow, but I think we've seen some selling and some pressure, and I think that will accelerate. And the weaker the economy gets, I think the more problem we're going to have here.
Thank you very much, Bubba. Tell us where we can find you and follow you.
BubbaTrading.com. Check me out and look at my daily update. I do a little 2-minute video every morning about the markets. And David, always a pleasure to be with you. I appreciate your time and thanks for having me.
We appreciate your time and thank you for coming back on the show. Thank you for watching. Don't forget to follow Bubba. Links down below. Don't forget to like and subscribe.